Welcome back to the Deep Dive. Today we're setting the textbooks aside for a bit.
Putting on our practitioner hats, you mean?
Exactly. We're diving deep into something absolutely fundamental for audit, something you just can't avoid, internal control.
It's the bedrock, really. It's what makes financial statements potentially trustworthy in the first place.
Yeah, and understanding it properly, like how it actually works, not just the definition. That's key for the exams and, well, for being a good auditor.
Absolutely. Get this wrong, and your whole audit strategy could be inefficient or worse, ineffective. Strong controls, they make our lives easier. Weak controls, that's a huge red flag.
So our mission today is pretty clear. We're going to break down why controls are so important strategically.
We'll dissect the pieces, the components, both old school manual systems and the IT environments we see everywhere now.
And then, crucially, we'll look at how we as auditors actually test them. How do we figure out if they're working?
Right. We'll cover everything from understanding the system right through to testing methods and, importantly, how we report any problems we find.
Okay, let's kick off with that strategic bit. Why is internal control such a big deal for management and, by extension, for us auditors?
Well, at its core, internal control is basically the set of rules and procedures management puts in place to make sure their instructions are followed.
Like making sure company policies actually happen in practice.
Exactly. If management says we need 2 signatures for any payment over £1,000, the internal control system is the mechanism, the forms, the checks, the software rules that enforces that. It turns policy into reliable action.
And it's management's job to build that system, right? Not ours.
100%. That's a critical point. Management is responsible for designing, implementing, and maintaining controls that ensure the financial statements are reliable, free from material misstatement, whether that's accidental error or deliberate fraud.
Okay.
Our job as auditors is to evaluate the system they've built. We don't create it for them.
And that evaluation directly feeds into our audit planning, specifically how we assess risk.
It's central to it. This brings us to control risk, CR. That's the risk that a material misstatement slips through the cracks because the client's own controls didn't prevent it or catch it.
So if the controls look weak, CR goes up.
Precisely. If the safety net has holes, the risk of something falling through is higher.
And thinking about that audit risk model,
Yeah.
Audit risk control, risk X detection risk if control risk is high. What does that mean for detection risk?
It means we, the auditors, have to slam the brakes on detection risk. We need it to be extremely low to compensate.
Why is that?
Because the overall audit risk, the chance we give the wrong opinion, needs to be acceptably low. If the inherent risk of the business is high and the client's controls are also rubbish, then the only way to get that overall risk down is for us to do a massive amount of work ourselves.
So we reduce the risk that our procedures miss something.
Exactly. We lower detection risk by significantly increasing our own testing.
Which means more work for us.
A lot more work. More substantive procedures. We can't rely on their systems, so we have to verify things directly, check more invoices, send more bank confirmations, do more analysis, maybe test year-end balances in much more detail.
So right at the start, we face this big decision point, don't we?
We do. Do we plan to rely on the client's controls because we think they might be effective? That allows a combined approach, testing controls and reducing other work.
Yeah.
Or do we assume the controls are likely ineffective and just plan for a full-on substantive audit from the get-go? Relying on controls is more efficient, but it's a gamble unless they actually work.
And that's a big if, because as you said, no system is perfect. There are always limitations, right?
Always. And understanding these inherent limitations is vital for maintaining professional skepticism. It stops us from becoming complacent.
Let's talk through those. What's the first big one? Maybe the most practical one.
Cost versus benefit. It's just not economical to have Fort Knox level controls over, say, the office stationery cupboard.
Right, controlling the paper clips costs more than the paper clips are worth.
Exactly. Management has to make a judgment. Controls are primarily aimed at preventing or detecting material misstatements, not every tiny error.
Okay, makes sense. What's next? Something universal.
The human factor. People make mistakes. Even with brilliant control, someone might just tick a box without really checking, or transpose numbers when typing, or get distracted during a reconciliation.
Simple human error.
Yep. Controls rely on diligent execution, and humans aren't always diligent, especially with repetitive tasks.
And what if people decide to deliberately ignore the controls?
Well, then you get into collusion. That's when two or more people team up to circumvent the system.
So if a key control is segregation of duties needing person A and person B.
Collusion blows that wide open. If the person raising a fake purchase order works with the person approving the payment, the control is useless. It looks like it worked, but it didn't prevent the fraud.
That's why skepticism is key, even if things look okay on the surface.
Absolutely. And then there's perhaps the trickiest one, often involving senior people.
Management override.
Exactly. This is when managers deliberately bypass controls that everyone else has to follow. Sometimes, maybe, they think it's for a good reason, like rushing an urgent order.
But the impact can be huge, right?
Yeah.
Especially for auditors.
Devastating. Because management override is the #1 way financial statement fraud happens. If the CEO tells the CFO to book revenue early, ignoring the rules, the system is overridden.
And it's hard to spot.
Very hard. Because the instruction might be verbal, off-system, the usual paperwork might look fine, but the underlying transaction is dodgy. It requires extreme skepticism and specific procedures to even try and detect it.
Okay, and one last limitation. Things that fall outside the normal routine.
Yeah, non-routine transactions. Controls are usually designed for the everyday stuff, sales invoices, payroll runs. When something unusual happens selling off a whole division, a really complex financial instrument, the standard controls often don't fit, or people don't know how to apply them.
So those transactions are riskier.
Much riskier. Higher chance of error or even manipulation because the usual checks and balances aren't there or aren't effective.
That's a pretty sobering list of why even good controls might fail. Okay, so knowing the why, let's look at the what's. What does an effective control system actually look like? Section 2, the anatomy, the components.
Right, there are 5 core components that kind of fit together. They provide the framework for everything else.
Component 1, the control environment. Sounds quite foundational.
It absolutely is. It's the tone at the top. It's about management's integrity, their ethical values, the overall culture of the organization regarding controls.
So, does management take this stuff seriously?
Exactly. Does the board exercise proper oversight? Are people held accountable? Are employees competent? If the control environment is weak and say, management constantly ignores internal audit findings, it taints everything else.
And for us auditors, a weak environment means
higher control risk across the board. We're immediately more skeptical. If the foundation is shaky, we can't really trust the specific controls built on top of it. We'd plan for more substantive work right away.
Okay, component 2, the entity's risk assessment process. This is management looking for problems.
Yes. How does management identify the risks specific to their business that could lead to material misstatement? Think risks like inventory becoming obsolete, or customers not paying, or errors in complex calculations.
And then they figure out how likely and how big those risks are.
Right. And based on that assessment, they decide where they need to focus their control efforts. It drives the design of the specific control activities.
Component 3, the information system and communication. This is about the flow of data.
Pretty much. It covers the entire journey of a transaction from initiation through recording and processing, any corrections, all the way to ending up in the general ledger and the final financial statements.
So the accounting system itself, the IT systems, the procedures.
All of that. And communication is key too, making sure everyone understands their roles and responsibilities within that system.
Component 4, control activities. These are the actual checks.
Yes, these are the specific policies and procedures that directly address the risks identified. Things like getting authorization, doing reconciliations, checking documents. We'll dig into these more in a moment.
And the final piece, component 5, monitoring of controls.
Yeah,
Keeping an eye on things.
exactly. How does the entity check that its controls are actually working over time? Big companies might have an internal audit department doing this.
And smaller ones.
It might be the owner-manager regularly reviewing management accounts, comparing budgets to actuals, following up on errors reported by the system. It's about finding and fixing weaknesses before they cause major problems.
Okay, let's zoom in on those control activities, component 4. These feel like the things we spend a lot of time testing as auditors.
We certainly do. They're the tangible actions. Probably the most famous one is segregation of duties.
Splitting up incompatible tasks, right. Authorization, recording, custody.
Precisely. You don't want the same person to be able to, say, approve a new supplier, record an invoice from them, and authorize the payment.
Why not? Give us a classic fraud scenario.
Okay, imagine someone can create a fake employee in the payroll system, authorization recording, and also process the wage payments, custody recording. They could create a ghost employee and divert the salary to their own bank account. Segregation prevents that single point of failure.
But that's often a real headache for small businesses, isn't it? They just don't have enough people.
It's a huge challenge.
Yeah.
In those cases, you have to look for compensating controls. Maybe the owner reviews every single payment personally, or does surprise cash counts, or insists on opening the bank statements themselves.
So we test those compensating controls instead.
Exactly. You have to assess if they adequately mitigate the risk caused by the lack of segregation. Often, it relies heavily on the owner's direct involvement and oversight.
Okay. Next control activity. Authorization and approval. Getting the sign-off.
Yeah, ensuring transactions are valid and comply with company policy. We look for evidence that the right person approved it. If company policy says the sales director must approve credit notes over £500, we check that the signature or digital approval actually is the sales director's.
And not just anyone's.
Right. And importantly, that the approval happened before the transaction was fully processed. Approval after the fact isn't really a control, and this applies to automated approvals too. Are the system limits set correctly?
Makes sense. Then we have verifications. Checking things match up.
Yes. Comparing two or more pieces of information, like matching the details on a supplier invoice to the goods received note and the purchase order, that classic three-way match.
That sounds like a detective control catching errors after they happen.
Often, yes. Or it could be comparing physical counts of inventory to the records.
Yeah.
The key isn't just the comparison. It's what happens if they don't match. Is there an investigation? Are corrections made and approved? That follow-up is part of the control.
Okay. And related to that, accounting reconciliations.
Crucial for completeness and accuracy. The bank reconciliation is the obvious one, making sure the company's cash book agrees with the bank's records.
And others too?
Oh, yes. Reconciling the payables ledger to supplier statements, reconciling control accounts to subledgers, checking intercompany balances, agree. These help catch errors, omissions, and especially timing differences around period-end cutoff issues. A reconciliation that just sits there with reconciling items that never get cleared isn't an effective control.
Good point. Finally, physical and logical controls. Locks and passwords.
Basically, yes. Physical controls protect tangible assets, locking up valuable inventory using security tags, safes for cash. Logical controls protect data and systems, strong passwords, multi-factor authentication, firewalls, carefully managed user access rights so people can only see and do what they're supposed to in the system.
Weak logical controls seem like a big open door in today's world.
A massive one. If anyone can log in as an administrator or access sensitive files, the risk of data theft, fraud, or just accidental damage is huge.
Okay. That covers the main types of control activities. Now let's see how these apply within specific business cycles.
Right.
Section 3. Controls in key accounting systems.
Right. We need to see how these controls create what we sometimes call a watertight audit trail. Can we follow a transaction from start to finish and back again and see the controls working at each step?
Let's start with the purchases system. Big area for spending and liabilities.
Key objectives here are making sure you only buy what you need from approved suppliers at sensible prices, and critically, that you only pay for what you've actually received.
So controls around ordering, like needing a purchase requisition.
Yes, and getting quotes, using an approved supplier list, and then the really critical control point.
The payment stage.
Before the payment. That three-way match we mentioned, invoice versus goods received, note versus purchase order. Someone independent needs to verify all three agree before that payment is even authorized.
What happens if that match fails?
Huge risk. You could pay the same invoice twice, pay for goods you never ordered, or pay for goods that never arrived. It's a classic area for both error and fraud.
Okay. Moving to the sales system. Revenue and receivables.
Here, the focus shifts to making sure sales are genuine, recorded accurately, and that you're likely to actually get paid.
So upfront controls are important, like credit checks.
Absolutely vital. You need strong controls over assessing a new customer's creditworthiness before you grant them credit and ship goods. Weak credit control leads to inflated sales figures followed by huge bad debt write-offs later.
And after the sale. Making sure you actually bill them.
Yes. Controls to ensure that every dispatch generates a timely and accurate invoice. You need completeness billing for everything you shipped, and accuracy getting the prices and quantities right.
And then chasing the cash.
Robust credit control procedures. Regularly reviewing the aged receivables listing, following up overdue debts promptly, processes for escalating problem accounts. This ensures the receivables on the balance sheet are actually collectible, that they're stated at net realizable value.
Got it. Next up, the inventory system. Often a big number on the balance sheet and prone to issues.
Definitely. Controls here need to cover both the physical items and their valuation. Physical security, locked warehouses, restricted access. CCTV helps prevent theft or damage.
And the valuation side.
Processes to identify slow-moving, obsolete, or damaged stock. These items might need to be written down to their net realizable value. You also need accurate, record-keeping perpetual inventory systems, ideally, and regular physical counts to verify those records.
Like cycle counting or a full year-end count.
Either or both. The key is reconciling the physical count to the records and investigating differences properly. Someone senior needs to approve any adjustments.
Okay. And lastly, non-current assets. Things like buildings, machinery.
These are usually low-volume, high-value transactions. Controls need to be tight. A key one is distinguishing between capital expenditure, buying a new asset, or significantly improving an old one, and revenue expenditure, just routine repairs and maintenance.
Why is that so important?
Because capitalizing repair costs incorrectly inflates assets and profits. You need clear policies and approval processes. Other controls involve ensuring depreciation is calculated correctly and consistently, physically tagging and tracking assets, and crucially, safeguarding documents of title deeds, registration documents to prove ownership.
Right. We've covered the main manual systems, but let's face it, most of this is computerized now, so Section 4. Controls in the digital age IT systems.
Yeah, the shift to IT changes the game. Processing is centralized, often faster, but errors can get replicated instantly. That old saying, GI go, garbage in, garbage out, is truer than ever.
If bad data goes in, bad information comes out, no matter how fancy the system.
Exactly. So the controls around data input become absolutely critical, often more so than in manual systems where a human might spot something odd.
Auditors usually split IT controls into two broad categories, right?
We do, yeah. It helps organize our thinking. We talk about general IT controls, or GITCs, and information processing controls, often called application controls.
Let's start with the general ones, the GITCs. These are the foundations for the whole IT environment.
That's a good way to put it. They support multiple applications. They cover things like how do users get access, passwords, user IDs, permissions. That's access security.
Okay.
How are new systems or programs developed or bought? Are they tested properly before going live? That's program development acquisition.
What about changes to existing programs?
Critically important. That's program change management. There needs to be a formal, controlled process authorization testing sign-off before any change is made to live software.
And finally,
Things like backups, disaster recovery plans, making sure the systems are actually running properly, that falls under operations and business continuity.
you stress change management there. Why is that specific GITC so vital for auditors?
Because it's a prime target for sophisticated fraud.
Yeah.
If someone can make an unauthorized change to the core accounting software, maybe add a line of code that rounds down every sales transaction by a fraction of a penny and diverts the difference to their account.
Wow. That could add up and be almost invisible.
Exactly. It's not a dodgy journal entry you can spot. It's buried in the program code. If the change controls are weak, we can't trust any output from that program. Testing the GITCs, especially change management, is fundamental. If they fail, relying on the specific application controls becomes very risky.
Okay, that makes total sense. So, if the GITCs provide the secure environment, let's look at the information processing controls, the ones within specific applications like sales or payroll.
Right. These are focused on ensuring transactions within that specific module are complete, accurate, and valid. We usually break them down further into input, standing data, processing, and output controls.
Let's start with input controls stopping the garbage in. How do we ensure completeness?
We look for things like sequence checks on pre-numbered documents, making sure there are no gaps before input, and control totals may be counting the number of invoices in a batch before and after input, or using hash totals on account numbers to make sure everything got entered.
And ensuring accuracy, preventing typos and obvious errors.
That's where edit checks come in. These are automated checks built into the data entry screens.
Like what? Give us some examples.
Okay, you've got range checks stopping someone entering a negative quantity ordered, for instance. Format checks ensuring a date field looks like a date. Presence checks making sure mandatory fields like a customer ID aren't left blank.
Any others?
Logical checks does delivery postcode makes sense for this customer's region. And a clever one is the check digit, an extra digit calculated mathematically from an account number or product code. If you mistype a number, the check digit calculation usually fails, flagging the error immediately.
Very useful. Now, you mentioned standing data controls separately. Why is standing data like price lists or supplier bank details a special risk?
Because it's used repeatedly. An error in one sales invoice affects, well, one invoice. An error in the standard selling price in the master file affects every single subsequent invoice for that product until it's fixed.
And the potential for fraud seems high too, changing bank details.
Exactly. If someone can change the bank account number in the supplier master file, standing data, all future payments to that supplier could be diverted. The risk is persistent and high impact.
So how should this be controlled? It's not like a transaction you approve.
You need specific, deliberate checks outside the normal transaction flow. We look for evidence that someone independent periodically prints out critical standing data fields, like supplier bank details or standard wage rates, reviews them carefully, and signs off to say they are correct. It requires active verification because people stop noticing static data.
Okay. Once data is in and validated, what about processing and output controls?
Processing controls check that the computer program ran correctly. We might look at run logs, which give a high-level summary of jobs processed to spot any unauthorized runs. We definitely look at exception reports.
Look at those.
These automatically list transactions that the system flagged as problematic. Maybe they failed an edit check or couldn't find a matching record. The control isn't just the report. It's the evidence that someone investigated and corrected those exceptions promptly.
And output controls, ensuring the results are right and go to the right people.
Yes. For printed reports, it might be simple things like page numbering or an end-of-report marker to ensure nothing's missing. For reports viewed online, it comes back to logical access controls, making sure only authorized people can view sensitive output, like payroll summaries or margin reports.
This brings us neatly to the auditor's own use of technology, automated tools and techniques, or ATTs.
Yes, we use computers to help us audit computer systems and the data within them. It massively increases our efficiency and sometimes the effectiveness of our tests.
What are the main types of tools we use?
We often talk about audit programs or audit software and test data. They serve different purposes.
Okay, audit programs first. These work on the client's actual data.
Correct. We use specialized software, sometimes called CAATs, computer-assisted audit techniques, to interrogate the client's data files directly.
What can this software do?
A lot. It can select samples much more scientifically, perhaps stratified samples focusing on high-value items. It can scan entire populations for anomalies like duplicate payments, credit balances and receivables, or transactions posted at unusual times. And it can reperform calculations across thousands or millions of records, very quickly recalculating depreciation for all assets, for example.
That sounds powerful.
Yeah.
What about test data? What's that for?
Test data isn't about analyzing the client's data. It's about testing the client's programs. We design a set of dummy transactions, some perfectly normal, some deliberately wrong or unusual, like an order way over the credit limit or an invalid product code.
And then you run these dummy transactions through their system.
Exactly. And this is crucial, usually on a copy of their live system or in a special test environment. We call it a dead run. You don't want your test data corrupting their real accounting records.
Right, and the goal is
To see if the client's programmed controls work as expected, we predict the outcome. The system should reject this invalid code. Then we run the test data and see if it actually does reject it. If it accepts the bad data, the control isn't working.
Okay, clear distinction. Beyond these tools, there's the broader concept of data analytics, DA.
Yeah, DA is really taking off. It's about using tools to find patterns, trends, correlations, and outliers in the raw data itself, often looking at 100% of the population. It helps with risk assessment and substantive testing.
Can you give an example of a specific DA routine auditors might use?
Sure. A good one is analyzing segregation of duties using system logs. We can perform what's sometimes called can-do, did, do testing.
How's that work?
The software compares user access permissions who can do certain actions, like create vendor, approve payment, against the actual transaction logs who did do those actions.
So you might find someone who shouldn't be able to approve payments actually did.
Precisely. Or maybe you find the same user ID created a new supplier and approved the first payment to them, bypassing the intended segregation. DA can highlight these potential conflicts across huge volumes of data very effectively, pointing straight to control weaknesses or even potential fraud. Other routines might involve inventory aging analysis, matching purchase orders to payments across the whole year, or complex gross margin analysis by product line.
The power seems immense. But are there downsides or challenges with using ATTs and DA?
Oh, definitely. It's not a magic bullet. Firstly, data integrity. Our analysis is only as good as the data the client gives us. If it's incomplete or inaccurate, our results are meaningless. GI Go applies to us too.
Okay, what else?
Data privacy is a big one. We're handling sensitive client data, so we need robust security and compliance with regulations like GDPR. Then there's the auditor skill set. Auditors need training to use these tools effectively and, just as importantly, to interpret the results correctly. It's easy to get overwhelmed by data or draw the wrong conclusions.
And you mentioned a more sort of philosophical challenge.
The black box problem. As client systems get more complex, using AI or machine learning for things like calculating provisions, it can become really hard for the auditor to understand how the system arrived at the number. We see the input, we see the output, but the process inside is opaque.
So we risk relying on a number we don't fully understand how it was calculated.
Exactly. Auditing the model itself, not just its inputs and outputs, requires very specialized skills. It's a growing challenge.
Okay, that paints a clear picture of the digital landscape. So let's bring it all together. Section 5. How do we practically evaluate and test these controls on an audit?
Right. The first step, before we can even think about testing, is we have to understand and record the client system.
Why is documenting it so important?
Several reasons. It forces us to understand the flow. It forms the basis for evaluating the design of the controls or their obvious gaps. And on a repeat audit, it's our starting point for seeing what's changed. You can't test something you haven't documented.
What are the main ways we document the system?
Traditionally, 3 main methods: narrative notes, flowcharts, and questionnaires.
Narrative notes are just writing it out in sentences.
Pretty much. Sales orders arrive by email, clerk A enters them, the system checks credit, manager B approves orders over £10. They can be quick to produce for simple systems.
But the downside?
They lack structure, it can be hard to follow the flow of different documents or easily spot where controls are missing or segregation breaks down, easy to miss things.
Okay. Flowcharts then. Using symbols.
Yes. Standard symbols for documents, processes, decisions, files. They take longer to draw initially, but they provide amazing clarity.
How so?
Because you can visually trace the documents, see exactly where checks are performed, like a comparison or authorization, and immediately spot who is doing what. Segregation of duties issues often jump off the page in a well-drawn flowchart. They impose a discipline that narratives lack.
And the third method, questionnaires. You mentioned there are 2 types.
Yes, and it's important to distinguish them. You have internal control questionnaires, ICQs, and internal control evaluation questionnaires.
What's the difference?
An ICQ is a checklist focused on the existence of specific controls. It asks simple yes-no questions. Are bank reconciliations prepared monthly? Are invoices stamped paid? A no answer immediately flags a potential weakness.
And the ICQ.
The ICQ is more sophisticated. It requires more auditor judgment. It focuses on whether the overall control objective is being met, considering all related controls.
Let's get an example.
Okay, the objective might be to ensure all goods dispatched are invoiced. The ICQ might ask, are dispatch notes matched to invoices daily? But the ICEQ asks, is the objective achieved? Maybe they don't match them daily. A no on the ICQ, but perhaps they have other strong controls like sequenced dispatch notes, automatically triggering invoice creation in the system that still meet the objective. The ICEQ requires you to assess the overall effectiveness of the controls related to that objective, not just tick boxes.
Got it. So once we've documented the system, and based on that we think the design looks okay, we then need to see if the controls are actually working in practice. Operating effectiveness.
Exactly. This is where tested controls come in. We need evidence that the control operated consistently throughout the period we want to rely on it.
And how do we get that evidence? What procedures do we use?
We use our standard audit procedures, but the main ones for testing controls are inspection, observation, and reperformance. Remember AEIOU from basic auditing, analytical procedures, inquiry, inspection, observation, reperformance, recalculation. For controls, it's mainly I, O, and U, reperformance.
Okay, inspection first, looking at documents.
Yes. Looking for physical evidence the control was done. A manager's signature on an expense report, a paid stamp on an invoice, a completed reconciliation with initials, a system log showing an approval. This is usually strong evidence if the document itself is reliable.
Observation.
Yeah.
Watching people do the control.
Like watching the warehouse staff perform the inventory count, or observing the mail opening procedures. It provides evidence that the control can be done.
But there's a catch, isn't there?
A big one. People often behave differently when they know an auditor is watching. They might do it perfectly for you, but slack off the rest of the year. So observation alone is rarely enough evidence of effectiveness throughout the period.
Okay, and reperformance.
This is us, the auditors, independently doing the control ourselves. If the control is the bank reconciliation, we take the bank statement and cash book and redo the reconciliation to see if we agree with the clients. Or we reperform the three-way match on a sample of invoices. It provides strong evidence.
Now, a really critical point for students, what about inquiry? Just asking people.
Inquiry asking the accounts clerk, do you check all the invoices before paying them, is essential for understanding the system, but it is never sufficient on its own as a test of operating effectiveness.
Right.
Because people might tell you what you want to hear or what they should be doing, not what they actually do. You absolutely must corroborate inquiry with other procedures, usually inspection or reperformance. Asking alone proves nothing about whether the control actually worked.
Okay, golden rule.
Yeah.
Inquiry is never enough for testing controls. So we've done our tests, maybe inspected a sample of 50 items. What happens next? We evaluate the results.
Yes. We compare the number of times the control failed deviations in our sample to what we decided was acceptable beforehand, our tolerable rate of deviation.
So if we tested 50 purchase orders for authorization and decided we could tolerate maybe 2 failures, 4%, but we found 3 failures, 6%, what then?
First, investigate those 3 failures. Was there a reason? Maybe they all related to one person who was covering holidays and didn't know the procedure. Are they genuine errors or something else?
What if, after investigation, the deviation rate is still too high, still above our tolerable rate?
Then we conclude that we cannot rely on that control. Our initial assessment of control risk for that area was too low.
And the impact on the audit plan?
We have to change it. We increase our assessment of control risk, and we increase the extent of our substantive procedures for the related account balance or transaction class. The hoped-for efficiency gain from relying on the control is lost. We have to do more direct testing of the numbers themselves. And that brings us to the final stage, really. Communicating what we've found. Specifically, reporting deficiencies in internal control to management. This is often done through a management letter, sometimes called a letter of weakness.
This feels like a really valuable part of the audit for the client.
It absolutely is. We're highlighting areas where their systems could be improved, potentially saving them money or preventing future errors or fraud.
So what exactly is a deficiency?
It's basically when a control is missing, or it's designed badly, or it's just not being operated correctly, and this failure could potentially lead to a misstatement in the financial statements.
And how should we structure the communication in that management letter to make it useful?
There's a standard practical structure, 3 parts for each point. 1, the problem weakness. Clearly state what you observed. Supplier invoices are not marked as paid after payment processing. Be factual and specific.
Oh.
2, the implication consequence. Explain why this matters. What's the risk? This creates a risk that invoices could be accidentally presented and paid a second time.
Right, the so what factor.
Exactly. 3, the recommendation. Suggest a practical, workable solution. We recommend that the payments clerk stamps all supporting documents paid immediately after the payment run is generated. Clear problem, clear risk, clear solution.
And are all weaknesses reported in the same way? What about really serious ones?
Good point. We distinguish between general deficiencies and significant deficiencies. These are weaknesses important enough that they need to be brought to the attention of those charged with governance, usually the board of directors or the audit committee.
What makes a deficiency significant?
It often involves things like potential for material misstatement, weaknesses related to fraud prevention, issues questioning management's integrity, or problems that management already knew about but hasn't fixed. These must be communicated in writing, and usually quite promptly.
Okay, so we've gone from the strategic importance through the components, the systems, IT, testing, and finally reporting. That's the whole cycle.
It really shows how interconnected controls are with the entire audit process, from planning right through to reporting. Understanding controls isn't just one topic. It underpins almost everything we do.
Yeah. And we started off talking about inherent limitations like management override and the need for skepticism. We've focused a lot on evidence we can physically see or reperform.
Inspection, reperformance, data analytics, tangible evidence.
But there's still a part of the audit, isn't there, that relies on something less tangible, management telling us things.
You're talking about written representation.
Exactly. That formal letter we get from management at the end of the audit, where they state things like, "We confirm that all known liabilities have been recorded in the financial statements."
It's required audit evidence, yes. But it's evidence of what management claims, not necessarily evidence of the underlying reality itself.
So it doesn't replace doing our own procedures.
Absolutely not. It complements other evidence, but it can never be the only evidence, especially for really important assertions, particularly assertions about completeness.
Why completeness specifically?
Because it's incredibly hard to audit for something that isn't there. How do you find a liability management has deliberately decided not to record, or revenue they haven't booked? You can test recorded items much more easily.
So when we get that representation saying, yes, everything's complete, and we have to place some reliance on it, what does that tell us about the limits of auditing, especially when it comes to deliberate fraud?
It really highlights that we provide reasonable assurance, not absolute assurance. If management is determined to deceive us, includes to hide things, and provides false representations, there's a risk, hopefully small, but real, that our procedures might not uncover it. That representation letter pins the responsibility squarely back on management for the truthfulness of the accounts. And if we later find out they lied in that letter, it's strong evidence of their intent. It forces us to maintain that high level of professional skepticism right to the very end, constantly evaluating management's integrity. We can't just blindly accept their word.
A crucial point to remember. Our skepticism must remain switched on throughout the entire engagement.
Always question. Always look in corroborating evidence. That's the job.
Fantastic.
Yeah.
A really thorough walkthrough of internal controls. Hopefully that gives you a much stronger practical understanding for your studies and beyond. And remember, you can find more SmartPodcast learning resources, notes, and questions covering everything we discussed today linked in the video description below.
Yes, and do subscribe to the SmartPass YouTube channel. We've got lots more expert guidance coming up to help you nail those exams.
Until next time, keep thinking critically and keep that skepticism sharp.